I'd now like to welcome Nick to the stage. And as he comes up, he sent me an interesting email. As you know, the English are on a bit of a roll with the sport. They've literally won everything other than the British Open that's humanly possible. But he sent me a note and said, while Kate Middleton was in Labor, suggesting that if this baby was Australian, it would obviously come out now. Nick.
Thanks, James. Sorry. Once in a lifetime there is an opportunity to gloat over the fact that the English are on a run over Australia, so you'll forgive me if I take advantage of it. Good morning, genuinely. It's great to be back here. And what I want to talk about today is really some of the big picture themes that we see in the world and how we see those shaping real estate. And talk a little bit about some of the potential risks out there and how that might affect your thinking about what you do going forward. I think it's interesting that if we look at the things that we're thinking about, that we're worried about now, they're actually the same things that we've been thinking about by and large or worrying about for about 4 or 5 years now. Without rehashing all of the detail, I think that there is positive news on all of these things, but at the same time, there are still big risks out there. Europe doesn't look as though it's about to explode. North America, quite clearly, there are signs of recovery coming through. China appears to be rebalancing its economy. Japan, we've seen Abenomics. But at the same time, I think, with the possible exception of America, where I really do think we are starting to see the signs of a fundamental recovery in economic momentum that is going to persist. And even that, as we'll see, can have some potential impacts. Everywhere else, there is still reason for concern, and particularly in Europe. I think that everybody's a bit bored with the European angst, and it's easy to sort of put it to the back of your mind. The truth is that we have a whole series of things going on which could bring back the threat of something rather nasty happening in Europe, which, even if it isn't cataclysmic, could have some pretty disruptive effects on the way in which we see the world. And particularly, I think, many citizens of many European countries are just bored with the situation and are increasingly frustrated at the lack of any growth prospects coming through. And we could see that coming through in different ways in terms of social unrest. But I mentioned that the US recovery looks as though it's really starting to take hold. And I think this heralds a new phase in which policymakers around the world are going to be starting to think about moving in different directions. Because up until now, everybody's been focused on kind of getting everything back and up and running again. But in Europe, policymakers are still going to have to be very focused on recession and promoting growth, as they are in Japan, as they possibly are in China. The US is going to pursue the policies that it thinks is right for the US, and that probably, is going to mean they're going to start shifting their policy stance and tightening and tapering and all the other things that we've started hearing about. And as we've seen in recent weeks, the markets are very nervous about what that might mean. And I'm going to come back and talk about that in terms of what I think it means for us in real estate. But to rehash comments that I've been making for a while now, because they've been true for a while now, prime quality real estate throughout the last 4 or 5 years, despite its role in some levels in the GFC, prime real estate has looked very attractive. And in many cases, still, depending on your view of what's going to happen, still looks very attractive because of its higher yield, because it's a real asset, because it, in some ways, offers at least the opportunity to hedge against inflation. And therefore, we've seen strong interest from all sorts of different buyers in all sorts of different markets in real estate. And therefore, it's not surprising that pretty much wherever you look in the world, prime quality real estate in particular looks expensive. It just does. It looks particularly expensive relative to where you would think real estate should be given the underlying prospects in particular markets, and we hear that a lot here in Australia. The market looks expensive relative to the fundamentals. To be honest, that's true in many places, and it's particularly true in many parts of Asia, where we're seeing very, very strong interest. Historically, investors here love investing in real estate, and the prospects, at least medium term, and until recently short term for growth, have been much stronger. But generally, we have still seen investors in most markets very focused on that prime end of the market. Let's just look a little bit at what's been happening in terms of capital flows. This is looking at cross-border investment in Asia-Pacific. And it differentiates. The dark colour here is non-Asia-Pacific investors. So that's capital coming into the region. The light colour, the light green, is Asian capital moving around the region. And what we were seeing up until about 12 months ago was sort of a reversal of the historic pattern that we saw pre-GFC. It was all about money coming into Asia-Pacific from outside. Post-GFC, that pretty much stopped. But we saw a big increase in the amount of Asian money moving around the region. We're still very much seeing that happen, and we think it's going to happen more going forward. But it is interesting that over the last 12 months, the last 4 or 5 quarters, you can see that dark green bar increasing. We've definitely seen an increase in the amount of money coming into Asia-Pacific from outside the region. What's interesting, if we look at what's happening in the Australian investment market, finally, someone's been listening. Because we've been saying for a while that we think the Australian market actually looks extremely attractive and good value. And you will see that almost exactly after Stephen McNabb and I sat down last year, there has been a step change in the volume of investment in Australia generally, and particularly a significant increase in the amount of capital coming into Australia from outside, the cross-border investment. And it's not as if Australia is simply riding a wave of money flowing in to everywhere. If you look at net cross-border investment, so what investors have been buying minus what they've been selling. If you look in the Asian markets, generally, and this is from outside the region, generally investors have remained net disinvestors in Asia. So even though we have seen money coming in, there's still more being sold by global investors in Asia than there is being bought. In contrast, here in Pacific, which principally is Australia, we are seeing a steady increase in the net investment, the flow of funds into Australia from elsewhere in the world. If we look, this is not cross-border, this is just the total volume of investment transactions that we track in commercial real estate. And over the last 12 months, the last 4 quarters up to the middle of the year, by a street, the Australian office market has been the most attractive and has seen the most cross-border investment. This includes Asian buying as well as money coming in from outside around the world. And if you look just slightly further down, the second largest dark green bar, the second largest segment for international investment, cross-border investment in Asia-Pacific is Australian retail. So quite clearly, investors are still very much targeting this particular market. And as we saw, we've seen a resurgence of domestic as well as international interest. And in large part, there are lots of reasons why I think the market's attractive, but in large part, I think this is the reason. You still hear an awful lot about the chase and the hunt for yield. There's loads of discussion here about, look at the value of incentives and da-da-da-da. Truth is, if you're buying a standing investment that's got a long WALE, those incentives are already paid away. You are getting a very, very attractive return when you buy here in Australia, even at the prime end of the market compared to other markets. I know there are risks. The point is, there are risks everywhere. So, what I want to turn to is the outlook from a slightly more global perspective in terms of policy and policy risk, and particularly some of the issues around what QE is currently doing and what might happen as we move forward. The IMF is not alone in pointing out that the ultra-low interest rates and the extraordinary policy measures, QE and other things like it, that are being implemented around the world poses significant risks in all sorts of ways, but particularly of causing asset bubbles. It encourages people to invest into fixed assets, particularly into things like real estate that are higher earning. And the IMF is pointing out that we're seeing all sorts of signs coming through in different places that are more like what you see at the top of an economic cycle rather than at the bottom, and they think that may well be down to what's happening from a QE point of view. If we look at Asia Pacific and just simply look at the trajectory of rental values in each sector and capital values over the last few years, you can see that particularly over the last 12 to 18 months, there has been a significant divergence. There's a divergence overall, but capital values are continuing to rise. This is very generalized. It's Asia-Pacific as a whole. But capital values generally continuing to rise far higher and to a far greater extent, and after we've seen a stabilization or in some cases even slight declines in what we're seeing from a rental value point of view. I personally, I don't think that in any meaningful sense and any general sense that Asia-Pacific has in its commercial real estate sector is a bubble. I think there are stress points and very, very keen pricing in certain parts of the market, but in general, I don't think there is. But the point is still, you know, it's quite difficult to see how much longer this is going to continue. In the absence of underlying economic growth and upward movement in rental values to drive performance, you know, how much further can capital values be pushed simply through yield compression, given the environment that we're in? The question arises, you know, why is pricing where it is and is it right? And that, of course, is an extremely difficult, if not an impossible question to answer. I think that there are a number of factors which underpin why real estate has started to look, prime real estate in particular, looks expensive in a number of markets. One is clearly that QE, in terms of its direct effect on bond yields, in terms of it therefore lowering the risk-free rate that everything is referenced against, just gives you an environment in which people are bound to start bidding up prices and down the yield on higher risk but still relatively safe investments. I think particularly if you look at what QE is designed to do, and there are loads of arguments, by the way, there's no widespread agreement on exactly how QE works, but some of the things it does include specifically targeting assets and trying to raise the value of assets, and specifically trying to engineer inflation. It's what it's designed to do, stave off the risk of deflation by engineering inflation. And for it to work, policymakers have to make you think that they're going to allow inflation to happen. If you think that they're going to go back to the old policies of rigidly targeting and making sure there's absolutely no inflation in the system, you wouldn't go out and buy assets and behave in the way that QE wants you to. So there's a kind of implicit assumption that we're going to live with a higher rate of inflation, which means in that environment, any asset that hedges against future inflation is going to look expensive. And if you think real estate looks expensive, and if you even think that, you know, German and US government bonds look expensive, look at what people are paying for TIPS, US inflation-protected securities, effectively index-linked, inflation index-linked bonds. And you can see, hopefully you can see, that those yields are actually negative on the 7, the 10-year bonds. So people are paying, they're not receiving any return, they're paying in order to protect themselves against future inflation. So it's not surprising if that's a kind of, and the point has been made by Bill Wheaton, who does a lot of work with us, you can think of a TIPS as a sort of asset-backed, inflation-protected bond. And it's not actually a bad collateral. It's not identical, but it's not a bad comparison. So in that environment, the question becomes what happens next, because we know that we're starting to move into a new phase. This discussion started about 2 years ago, and then we had the summer of 2011 when the world looked as though it would explode and everybody's kind of forgotten about it. But the real issue is, where are we going next? And it really is worth bearing in mind that even established and experienced policymakers accept that the policies that have been implemented, the situation that we're in now, and what we need to go through to get out of it from a policy unwinding point of view is completely unprecedented. In the nicest possible sense, they have no idea what they're doing. They're making it up as they go along. There's a lot of very bright people thinking about what they should be doing and how it should work, but the truth is they really don't know. And experienced bankers, central bankers, are saying we don't even actually know really what's going on in the economy. They don't really understand why QE isn't having more of a direct effect on the underlying economies in the way that it was designed to do. So in that environment, it's difficult to believe that they're going to be able to navigate us through the next 5 to 7 to 10 years without there being quite a lot of wobbles. And the reason people are concerned is that there have been episodes in the past, 94 is one of the ones that's pointed to, when the Fed unexpectedly started to move interest rates, and as a result there was severe turbulence in the bond markets. the risks, particularly in this environment where we're starting to get the US potentially moving in one direction, but the rest of the world moving in another. Central bankers sending different messages. The currents are becoming more complex. It's not a tide that we're swimming against anymore. There's going to be lots of whirlpools, lots of eddies as the effects ripple out and change. One of the key points that's been made is forward guidance is absolutely key. The way to try and stabilise the markets is to send out a message about what we think is going to happen. And I think thinking has changed a bit on that, that what we expect to see is a message coming out, but then the 2 steps forward, 1 step back. If the markets aren't reacting in the way that Bernanke or other policymakers want, they'll just ease off again. So we can expect to see some seesawing of policy and some volatility. The trouble is that this is a massive game, particularly in the bond markets. It's a massive game of you know that I know that you know that I know that who can get out first. Because whatever Bernanke says, I might start thinking about doing something or doing less of something in September. Bond investors are terrified that everybody's going to move at exactly the same time. The impact on the bond markets can be instantaneous, literally. So everybody wants to be the one to get out ahead of everybody else. And of course, you can't. So it's very difficult for policymakers, even if they know what they want to achieve, to make that happen in the market. And we said, right, well, a TIPS is a bit like real estate. And we know that we've got very low bond yields that we're kind of referencing the pricing of real estate against. So even if we think real estate's quite expensive, we can take some comfort of the fact that everything else is expensive, so you know we can still rationalise it. This is what happened in a matter of days to the TIPS yield recently when Bernanke made the comments that he did. Actually, maybe he's not going to allow quite as much inflation in the system as we first thought. He may be acting sooner than we thought because the US economy is now further ahead in its recovery than we thought. Look at what happens to the yield. Suddenly, if you're using that relative to bonds argument, your justification for paying what you've been paying has just shifted somewhat. Now, that's not the only reason why, but it does show just what kinds of volatility we could see in the wider financial markets that could start feeding through. Because the question is, what does the increase in bond yields that we know is coming, it's just a matter of when and how quickly, what does that mean for the pricing of real estate? Does this flow through immediately into higher property yields? Well, the answer is not necessarily, because there are 2 fundamental components in the relationship between, say, government bond yields and real estate yields. The first is the risk premium that you apply to real estate. The second is the level of rental growth that you expect from the asset you're buying. And whilst property looks quite expensive relative to itself over time, particularly relative to economic and rental growth expectations, the truth is around the world, property has never looked cheaper relative to government bonds. Because the spread between property yields and government bonds in many markets is pretty much as high as it's ever been. So one argument is that bond yields are going to rise because risk in the world has come down. Therefore, the risk premium between real estate and the bond yield will compress again to a more normal level. So that increase, at least part of that increase in bond yield, will be absorbed by a normalisation of the spread to property. Second argument is that lower risk environment is as a result of improved economic conditions. Therefore, the outlook for rental growth should be better. Therefore, my rental growth expectations on my asset should improve. And therefore, again, that may not mean that you get compression of the yield, but the increase in the bond yield may not necessarily result in an increase in property yields. So the answer is, what's the impact of bond yields? It depends. Which market are you in? What type of asset are you in? What sector? How does it or doesn't it compare to a bond? And how are those different factors around how risky the asset or the sector is and what the outlook for economic growth and rental growth is? It all depends. And it's impossible to talk of property because every building has its own characteristics. So what you need to think about, and what we're thinking about with clients, and it's not easy, but is, what are the different scenarios that we could see about what policy does and therefore what bond yields and other asset classes might do versus what do we think is going to happen to economic conditions and rental growth? And you can plot lots of different scenarios. And the key, I suggest, is not necessarily to try and pick absolutely which one you think is going to happen, but think through, if any of these combination of things starts to happen, what would it mean for me, and how vulnerable am I? And I think that this is my final point. Anybody who tells you exactly that they know exactly what the world's going to look like in 3 years' time, 5 years' time, I think is either lying or they're deluding themselves. You know, I'm generally pretty optimistic about the next 10 years. Actually, I'm generally very optimistic about the next 10 years. But we have no idea what it's going to look like. Except that I think we know it's going to look bumpy. And the key issue is, in volatile times, you really want to try and avoid tying yourself to particular key dates over which you have no control of the date, because you don't know what the world is going to look like at that point in time. So any point where you could end up being forced to refinance or raise capital or roll over debt or sell an asset, it is very difficult to know what the world is going to look like. It's not enough to know the 6-foot man crossing a river that on average was only 5 foot deep. There's no use in being able to, on average, get through the next 10 years. You've got to be able to survive the bumps and the ups and downs in the road. Easier to say than to do, but I close by saying that generally I think it's going to be easier to do in Australia with pricing and the assets and the market environment you've got here than it will in many other places. I hope that's given you a high-level view of how we see the world before we turn to look more detail in Australia. Thank you very much.